The Agrarian Foundation. Freshly unified under a brand new constitution, a fragile republic builds its economic base. Markets are highly localized, driven by agriculture, canals, and early textile mills. Inflation is violently volatile, driven by scattered state banking and the War of 1812. In 1792, Coinage Act of 1792 establishes the United States Mint and regulates the coinage of the nation, pegging the US dollar to specific weights of gold and silver in a bimetallic standard. In 1792, Buttonwood Agreement. 24 stockbrokers and merchants signed the Buttonwood Agreement on Wall Street, establishing the origins of the New York Stock Exchange and structurally organizing early American capital markets. In 1812, War of 1812, the United States declares war on Great Britain, leading to severe trade disruptions, the burning of Washington, D.C., and a massive expansion of national debt to fund the conflict. In 1819, Panic of 1819, the first major peacetime financial crisis in the United States, driven by a collapse in global cotton prices, rampant Western land speculation, and a sharp contraction of credit by the Second Bank of the United States. In 1832, the Bank War and Veto. President Andrew Jackson vetoes the recharter of the Second Bank of the United States, dismantling the centralized banking system and initiating a decentralized and highly volatile state banking era. In 1837, Panic of 1837. A severe speculative collapse triggered by the specie circular and falling cotton prices, resulting in a multi-year economic depression, widespread state bank failures, and record-high unemployment. The Gilded Age and industrial expansion. The railroad transforms America into a unified continental market. Massive industrial monopolies rise alongside a brutal boom and bust cycle of financial panics, while the strict gold standard keeps long-term inflation mathematically locked in place. In 1857, Panic of 1857. The failure of the Ohio Life Insurance and Trust Company triggers a nationwide panic, exacerbated by the sinking of the SS Central America, which was carrying critical gold reserves needed by Eastern banks. In 1861, American Civil War outbreak. The outbreak of the Civil War splits the nation, destroying the Southern plantation economy and forcing the Union to issue unbacked fiat currency known as greenbacks to fund the massive military mobilization. In 1863, National Banking Act of 1863. Designed to help finance the Civil War, this act established a system of national banks and a uniform national currency backed by U.S. Treasury securities, stabilizing the fractured domestic monetary system. In 1869, Transcontinental Railroad completion. The Golden Spike is driven at Promontory Summit, linking the eastern and western U.S. rail networks. This revolutionizes domestic supply chains, slashes freight costs, and fuels massive railroad equity speculation. 1873, Panic of 1873, and the Long Depression. The collapse of J. Cook and Company, overextended by railroad speculation, triggers a massive financial panic, initiating a severe 65-month economic contraction, known globally as the Long Depression. In 1893, Panic of 1893, a severe economic depression in the United States marked by the collapse of railroad overbuilding and shaky bank financing, leading to systemic bank runs and widespread equity liquidation. The Age of Upheaval, a half-century of extreme volatility. The creation of the Federal Reserve, 2 world wars, and the Great Depression fundamentally alter the relationship between the government and the economy. The modern stock market is officially born. In 1900, Gold Standard Act, an act defining the United States dollar purely by gold weight, ending bimetallism and legally requiring the Treasury to redeem paper currency in gold coin. This stabilized the dollar, but restricted domestic monetary expansion. In 1907, the Panic of 1907. A severe systemic liquidity crisis triggered by a failed attempt to corner United Copper stock. The collapse of cascading trust companies caused severe bank runs and evaporated NYSE liquidity, ultimately forcing J.P. Morgan to intervene and leading directly to the creation of the Federal Reserve. In 1913, Federal Reserve Act of 1913, President Woodrow Wilson signs legislation establishing the Federal Reserve System, creating a centralized monetary authority to serve as a lender of last resort and structurally stabilize systemic liquidity. In 1914, World War I outbreak and NYSE closure. The outbreak of World War I forces the New York Stock Exchange to suspend all trading operations for over 4 months to halt the massive, panicked liquidation of U.S. assets by European investors. In 1929, Wall Street crash of 1929. The catastrophic collapse of the speculative Roaring '20s equity bubble, peaking with Black Thursday and Black Tuesday. This event triggered an 80% peak-to-trough drawdown and initiated the Great Depression. In 1930, Smoot-Hawley Tariff Act, a protectionist trade law that raised U.S. tariffs on over 2,000 imported goods, severely damaging global trade volumes, provoking retaliatory international tariffs, and compounding domestic depression dynamics. In 1932, Revenue Act of 1932. Signed into law by President Herbert Hoover, this act implemented the largest peacetime tax increase in United States history. Intended to balance the federal budget, it sharply raised top marginal rates and corporate taxes, which severely contracted aggregate demand and exacerbated the Great Depression. In 1933, Executive Order 6102, Gold Nationalization. President Franklin D. Roosevelt outlaws the private hoarding of gold coin, bullion, and certificates within the United States, effectively nationalizing gold reserves to devalue the dollar and expand the domestic money supply. In 1933, Banking Act of 1933, Glass-Steagall, sweeping banking reform that separated commercial banking activities from investment banking. It also established the Federal Deposit Insurance Corporation, FDIC, to restore public confidence and halt systemic bank runs. In 1934, Securities Exchange Act of 1934, major legislation establishing the Securities and Exchange Commission, SEC, to oversee secondary market trading, enforce financial disclosure laws, and structurally eliminate unchecked market manipulation. In 1939, start of World War II in Europe. Germany invades Poland, triggering declarations of war from Britain and France. This instigates a massive reallocation of global capital, skyrocketing defense manufacturing, and sweeping wartime tax structures across global economies. In 1941, Pearl Harbor attack and World War II mobilization. The surprise military strike triggers formal U.S. entry into World War II, transitioning the nation into a state-directed command economy with total price controls, corporate rationing, and massive debt issuance. In 1944, Bretton Woods Agreement, a landmark international accord establishing a global monetary framework where member nations pegged their currencies to the US dollar, which was directly convertible to gold at $35 per ounce. In 1945, atomic bombings end VJ Day. The United States detonates atomic weapons over Hiroshima and Nagasaki, forcing the unconditional surrender of Imperial Japan. This abrupt conclusion to World War II triggered a massive global industrial pivot and established the geopolitical risk framework for the Cold War era. Post-war boom and the Great Inflation. America emerges as the undisputed global superpower, fueling a massive middle-class expansion. But the 1970s bring a rude awakening. Untethered from gold, runaway stagflation relentlessly erodes the purchasing power of the dollar. In 1950, Korean War. The sudden outbreak of the Korean War triggers a massive mobilization of the United States economy. The ensuing inflation spike forces the Treasury and Federal Reserve to negotiate their historic 1951 accord, permanently altering domestic monetary policy. In 1951, Treasury-Fed Accord, a landmark agreement between the U.S. Treasury and the Federal Reserve that allowed the central bank to formulate monetary policy independently, effectively ending its World War II-era obligation to peg interest rates on government debt at artificially low levels. In 1964, Vietnam War escalation. Following the Gulf of Tonkin resolution, the U.S. drastically escalates military involvement in Vietnam. The simultaneous deficit funding of the war and domestic social programs creates severe structural inflation, eventually forcing the abandonment of the gold standard. In 1971, launch of the NASDAQ. The National Association of Securities Dealers Automated Quotations, NASDAQ, officially launches as the world's first electronic stock market. It initially acts as a quotation system rather than an execution engine, fundamentally shifting the future of equity trading away from physical floors. In 1971, Nixon shock. President Richard Nixon unilaterally suspends the direct convertibility of the US dollar into gold, permanently destroying the Bretton Woods architecture and initiating the modern era of unbacked floating fiat currencies. In 1973, OPEC oil embargo. OPEC implements an oil export embargo against Western nations supporting Israel in the Yom Kippur War, causing crude prices to quadruple, sparking structural stagflation, and triggering a deep secular equity bear market. In 1974, Employee Retirement Income Security Act, ERISA. Signed into law by President Gerald Ford, ERISA established minimum standards for pension plans in private industry. This structurally shifted institutional capital, essentially creating the modern landscape of mutual funds and massive 401k equity inflows. In 1978, Iranian Revolution and Second Oil Shock. The collapse of the Iranian monarchy drastically reduces global oil output. The resulting panic buying causes crude prices to more than double, cementing the stagflation environment of the late 1970s and crippling equity valuations. In 1979, Volcker anti-inflation tightening cycle. Federal Reserve Chair Paul Volcker alters operating procedures to aggressively restrict money supply growth, driving the federal funds rate past 20% to crush deeply embedded structural inflation at the cost of a severe double-dip recession. In 1987, Black Monday, 1987. The largest single-day percentage drop in Dow history. Structural systemic failure occurred when programmatic portfolio insurance models generated unhedged sell loops in S&P futures, breaking the arbitrage link with cash equities and forcing market-wide circuit breakers. The digital era. The invention of the World Wide Web ushers in the modern technology age. A massive speculative dot-com boom accelerates the economy, permanently transforming global communication and commerce. In 1990, Japanese asset bubble burst. The Bank of Japan raised interest rates to combat rampant speculation, intentionally popping a massive equity and real estate bubble. This initiated the Japanese lost decades and forced the world's first central bank experiment with zero interest rate policy. In 1993, Omnibus Budget Reconciliation Act of 1993. President Clinton signs a major deficit reduction package that raises top tax rates while capping discretionary spending. This progressive fiscal conservatism becomes a primary catalyst for the structural budget surpluses of the late 1990s. In 1993, NAFTA signed. President Clinton officially signs the NAFTA Implementation Act into law. This agreement fundamentally restructures North American supply chains, accelerating globalization and structurally altering multinational corporate earnings. In 1998, Russian sovereign default. Russia unexpectedly devalued the ruble and defaulted on its domestic debt. This severe sovereign shock triggered a global flight to liquidity, acting as the primary catalyst for the catastrophic failure of long-term capital management, LTCM. In 1998, LTCM collapse and Wall Street bailout. Highly leveraged hedge fund long-term capital management faces imminent failure. The Federal Reserve orchestrates a $3.6 billion private bailout by major banks to prevent a systemic fire sale of assets and stabilize global markets. In 2000, dot-com bubble peak and burst. The peak and subsequent collapse of the tech-heavy NASDAQ composite, leading to massive equity devaluation and a shift in market valuations. In 2001, 9/11 attacks and aggressive rate cuts. Geopolitical shock, prompting the Federal Reserve to aggressively lower the federal funds rate to shore up liquidity and market confidence. In 2001, Enron bankruptcy. The exposure of systemic, complex accounting fraud led to the immediate collapse of the energy conglomerate. It wiped out billions in shareholder value, destroyed Arthur Andersen, and shattered investor confidence in corporate financial reporting. In 2003, Jobs and Growth Tax Relief Reconciliation Act, JGTRRA. President Bush signs JGTRRA, slashing the maximum tax rate on corporate dividends and long-term capital gains to 15%. This structural fiscal shift massively incentivizes equity investment and acts as the primary fiscal catalyst for the mid-2000s bull market. In 2004, American Jobs Creation Act, repatriation holiday. Congress enacts a one-time tax holiday, allowing U.S. multinationals to repatriate foreign earnings at a drastically reduced tax rate. This triggers a massive influx of offshore capital in 2005, driving a wave of corporate stock buybacks and special dividends. In 2005, Regulation NMS adoption. The SEC adopts the national market system to modernize U.S. markets. By mandating that orders be routed to the exchange displaying the best price, the rule inadvertently catalyzes the high-frequency trading, HFT boom, and fragmenting liquidity across multiple dark pools and electronic venues. In 2006, U.S. housing market peak. The U.S. housing market reaches its definitive price peak after a massive credit-fueled boom. While initially dismissed by equity markets as a contained sector slowdown, The subsequent decline in home values acts as the structural tripwire for the global financial crisis. The Great Recession and infinite liquidity. The 2008 financial collapse brings the global banking system to its knees. In response, central banks unleash unprecedented quantitative easing, artificially suppressing interest rates and pushing the S&P 500 into a staggering historic bull run. In 2008, Bear Stearns collapse and Maiden Lane bailout. The sudden liquidity collapse of Bear Stearns forces a Federal Reserve-backed rescue by J.P. Morgan Chase. The Fed creates the Maiden Lane vehicle to purchase toxic assets, establishing a massive precedent for central bank balance sheet expansion. In 2008, the global financial crisis and QE1. The systemic collapse of the shadow banking system and Lehman Brothers forces central banks to slash rates to zero. To stabilize cascading market failure, the Federal Reserve initiates quantitative easing, permanently altering its balance sheet by purchasing trillions in toxic assets. In 2008, Lehman collapse and QE1 launch. The collapse of Lehman Brothers triggers the global financial crisis, prompting the Federal Reserve to initiate unprecedented large-scale asset purchases, quantitative easing. In 2008, Reserve Primary Fund breaks the buck. Following the Lehman Brothers bankruptcy, the Reserve Primary Fund net asset value dropped below $1. This triggered a systemic panic across the money market industry, instantly freezing global short-term commercial paper funding. In 2008, Emergency Economic Stabilization Act, TRP, signed on October 3, 2008, creating a program authorizing the Treasury to purchase up to $700 billion in troubled assets to stabilize the financial system. In 2008, Quantitative Easing 1, QE1, formal launch. The Fed formally launched QE1 with an initial $600 billion in housing debt and mortgage-backed securities. In March 2009, the program was expanded to include $300 billion in long-term treasuries, permanently altering central bank balance sheet dynamics. In 2010, the 2010 flash crash. An intraday microstructure failure where an institutional E-mini sell order combined with rapid algorithmic HFT position rotation. This toxic volume loop drained the central limit order book, forcing automated market makers to temporarily withdraw all liquidity quotes. In 2010, Dodd-Frank Wall Street Reform Act, the most significant overhaul of U.S. financial regulation since the Great Depression, enacted in response to the 2008 financial crisis. It mandated higher capital requirements, stress tests, and the Volcker Rule to limit proprietary trading by commercial banks. In 2010, Quantitative Easing 2, QE2. Implemented in November 2010, this round of quantitative easing consisted of a $600 billion purchase of long-term Treasury securities. In 2011, Fukushima nuclear disaster. A massive earthquake and tsunami triggered a triple meltdown at the Fukushima Daiichi nuclear plant. The event caused a flash crash in the Nikkei, broke global manufacturing supply chains, and structurally devastated the global uranium market. In 2012, Quantitative Easing 3, QE3. Launched in September 2012, the Fed initiated an open-ended purchasing program initially involving $40 billion a month of agency mortgage-backed securities. In 2017, Tax Cuts and Jobs Act, TCJA. Major legislative overhaul reducing the corporate tax rate from 35% to 21%, dramatically increasing corporate profits and stock buyback volume. In 2020, COVID-19 and the liquidity supernova. Global pandemic shutdowns trigger a massive deflationary shock. In response, the Federal Reserve unleashes open-ended quantitative easing while the CARES Act injects direct fiscal stimulus. This unprecedented coordination of monetary and fiscal policy rapidly expands the total M2 money supply. In 2020, CARES Act and helicopter money. A $2.2 trillion economic stimulus bill that introduces direct stimulus checks to citizens and the Paycheck Protection Program, PPP. This act merges fiscal deficit spending with monetary easing, flooding the real economy with M2 money supply. In 2020, WTI crude negative pricing. A severe demand shock combined with maximum capacity at physical storage hubs in Cushing caused the May WTI futures contract to collapse to negative $37 per barrel, fundamentally breaking commodity pricing models. In 2021, American Rescue Plan Act, RPA. Signed on March 11, 2021, this $1.9 trillion stimulus package injected direct liquidity into the economy, dramatically accelerating monetary expansion. In 2021, Fed taper announcement and transitory pivot. Jerome Powell officially retires the claim that inflation is transitory before Congress and accelerates the tapering of pandemic-era bond purchases. This severe shift in liquidity expectations marks the definitive peak of the post-COVID equity bull market. In 2022, Russia-Ukraine war and commodity shock. Russia initiates a full-scale invasion of Ukraine, triggering immediate global economic sanctions, a structural fracturing of geopolitical supply chains, and a massive supply-side price shock across crude oil, natural gas, wheat, and nickel markets. In 2022, Federal Reserve rate hike cycle. The Federal Reserve aggressively hikes the benchmark interest rate from near zero to over 5% to combat roaring consumer price inflation, compressing the equity risk premium. In 2022, Inflation Reduction Act, IRA. Despite its title, the 2022 Inflation Reduction Act had virtually zero impact on inflation. Uncapped green energy tax credits pushed total projected costs from $370 billion to over $1.2 trillion, functioning primarily as a massive green subsidy package. The legislation distorted traditional energy markets, misallocated capital, and structurally increased utility and tax costs for everyone. In 2022, UK LDI pension crisis. A structural margin doom loop in the UK gilt market. Aggressive spikes in long-dated yields triggered massive cash collateral margin calls for leveraged liability-driven investment, LDI pension funds, forcing them to dump more gilts into a dead market. In 2022, ChatGPT launch and the generative AI supercycle. OpenAI publicly releases ChatGPT, demonstrating the viability of large language models. The release instantly catalyzes the generative AI boom, triggering massive concentrated capital flows into mega-cap tech, semiconductor foundries, and the broader data center infrastructure grid. The artificial intelligence supercycle. The public release of ChatGPT triggers an explosive paradigm shift. Silicon Valley enters an arms race for computing power, minting multi-trillion-dollar tech behemoths and setting the stage for the next industrial revolution. In 2024, Federal Reserve jumbo rate cut pivot. The Federal Reserve officially pivots from its aggressive anti-inflation tightening cycle, delivering a massive 50 basis point rate cut. This marks the beginning of a new easing cycle, immediately injecting fresh liquidity expectations into the market and steepening the yield curve. In 2024 U.S. presidential election victory. Donald Trump secures victory in the 2024 U.S. presidential election. The decisive result instantly clears electoral uncertainty and sparks a massive risk-on rally across domestic equities, crypto, and the U.S. dollar on expectations of rapid deregulation and sustained deficit expansion. In 2025, Liberation Day tariffs announced. The administration officially announces sweeping reciprocal tariffs targeting a cumulative U.S. trade deficit exceeding $18 trillion since NAFTA. This sustained structural capital outflow necessitated massive foreign borrowing, directly accelerating the expansion of the national debt. The policy shift ignites immediate fears of a systemic global trade war and corporate margin compression, triggering a severe and rapid liquidation event across broad market equities. In 2025, Liberation Day global tariff pause. President Trump unexpectedly announces a 90-day pause on his sweeping Liberation Day reciprocal tariffs for most global trading partners. The sudden walkback triggers a historic relief rally, with the S&P 500 surging 9.5% in a single day as systemic recession fears momentarily evaporate. In 2025, Ramageddon global memory crisis. A structural supply shock in the semiconductor market drives unprecedented inflation across global memory components. Major fabricators aggressively redirect DRAM and NAND capacity to fulfill massive AI data center demands, locking out consumer electronics and sending hardware prices skyrocketing. In 2025, One Big Beautiful Bill Act, OBBA, major structural legislative package enacted under the Trump administration, driving historical deficits and significantly expanding the forward trajectory of national debt, putting long-term structural upward pressure on total system M2 liquidity bases